Welcome, folks, to the Trump Factor on the Markets and Economy and ETFs webinar. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com, and I'm joined by Rick Wedell, President and Chief Investment Officer at RFG Advisory, Tom Graff, Chief Investment Officer at Facet, and Andrew Goins, Senior Portfolio Manager at Brinker Capital Investments. Thanks for being here, guys.
Thank you for having us.
Yeah, thanks for having us.
All right, we're talking about, this is Donald Trump's second term. All right, that's not a surprise to anyone. A lot of people are referring to it as Trump 2.0. He was president, then he wasn't president, now he's president again. And a lot of things have happened in short order. He's delivering on things that he said he was going to do, so that part shouldn't be a surprise to people. But what we're looking at through the prism of the markets and the economy and investing is how these things, these policies from the Trump administration may or may not be impacting investments, what financial advisors need to focus on. Just as a little primer, we're going to talk about the tariffs, the Department of Government Efficiency, inflation, Fed policy, everything. But for a little context here, this is actually right around the 1 month mark for Donald Trump's second term. Since that time, the S&P 500 has gained 1.7%. Talking 4 weeks, folks. Gold is up 7%. Bitcoin is down 7.2%. And the 60-40 portfolio model is up about 1%. Since the election, November 4th, the S&P is up 7%, gold is up 7%, Bitcoin's up 40%, and the 60-40 model is flat. All right, we're going to get into all of the market situations, the outlooks, the conditions, the factors. But first, I want to go around the horn and have each of you gentlemen introduce yourselves so we can all appreciate why you're the experts to be here. Rick, how you doing?
I'm well, thank you, Jeff. My name is Rick Wedell. I'm the President and Chief Investment Officer at RFG Advisory. We are about a $6 billion regional RIA with offices across about 30 states. And I'm just pleased as punch to be here.
Okay, Tom Graff, how are you, sir?
Great. Yeah, so I'm Tom Graff. I'm Chief Investment Officer at Facet. So I oversee all things investment for the firm, and we're a fintech financial planning firm. So we serve about 14,000 clients all across the country and manage about $4 billion in assets.
Okay, and Andrew Goins.
Great, thanks, Jeff. Yes, I'm Andrew Goins. I'm a Senior Portfolio Manager at Brinker Capital Investments, and I co-manage our multi-manager, multi-asset class portfolios called Destinations with about $12 billion in assets under management.
Okay, excellent, thank you. Let's start off a little bit of big picture stuff here with the foundation of what the financial markets might be expecting or have expected under Trump's second term. Andrew?
Yeah, I mean, so far, clearly we're seeing a little bit more volatility in the markets, and I think that is probably the main thing we should expect, or maybe the thing that I have the most confidence in saying as far as what's going to happen over the next year to 4 years is probably just more volatility. And so far we've seen that, as you've said, the markets you may not over the last week, over the last month, I've not seen a lot of movement, but day to day, based off of headlines in the news, we're definitely seeing the market react pretty meaningfully, and would expect that to continue going forward.
Tom, are you seeing, you have kind of the same feeling? Obviously, there's a lot of people that are talking about the markets being frothy. This is something that has been building up well before Trump's second term started. So there could be things that are catalysts to kind of trigger some of the volatility. But what's your thoughts on the markets under Trump?
Yeah, I mean, I think obviously, look, there's no denying there's been a lot of volatility in the last, at least definitely since the election, but particularly since inauguration. But it's just really interesting. There's kind of two drivers of that. You've got this big uncertainty around Trump policies. It's been especially tariffs, but there's also some tax and some immigration stuff mixed in there that I think economists and traders care a lot about. But you also have a lot of questions about valuations, frothiness in AI-related stocks. I mean, we keep making new highs. They're driven by a relatively small number of stocks, and I think there's a general sense that isn't long-term sustainable. Like either earnings growth needs to spread out, or there could be a problem. And so I think both those things are both contributing to volatility.
And Rick, what are your thoughts on that?
I'd just say a couple of things. I think to add on to a little bit what Tom said, you have an entire narrative out there that's sort of evolving around inflation, unemployment, and future path of interest rates that I think is also contributing a decent amount to sort of the market volatility level, as we start to think about, okay, where is the Fed headed, and what does that mean? And then the other thing that I would just note, humans have a little bit of a thing called recency bias. We like to expect that what we are currently experiencing will be very similar to what we've experienced in the very recent past. And certainly if you look at, one of my favorite metrics of, how volatile does the market feel is how many days in a given year does the market move by more than 1%, right? If you look at, 2023, 2024, both of those were in the sort of mid 30s, I think 37, 38 days for each one of those years. Historical average for the market is actually closer to 60. So part of the reason why, and by the way, year to date, we've had 7, which puts us on track for the historical average. So part of the volatility that we're all experiencing right now, I'd just like to remind everybody, is actually more of a return to what I would call normal levels of market volatility, as opposed to, just the change factor from what were relatively non-volatile years in 23 and 24.
Okay. I want to remind our audience that we are taking questions throughout. If you submit them, we'll get to them as efficiently as we can. We're not having Q&A at the end. I'm just gonna filter through them as they show up. So if you have something you want to ask, please do. I know like I said, it's only been a month, but we're gonna grade President Trump's first month in office for his second term in the context of the markets. Tom, what are your thoughts? How do you?
Can I pass? Can I do that?
I mean,
look, I think
you can.
Well, okay.
Unaware that we would be grading.
But you're
right.
Well, I don't care whatever scale you want to use. You don't have to call it a grade. You can just call it a comment or a critique, or you can even point out a single thing or two that you think is noteworthy.
Well, how about I'll put it this way. Okay, so what matters to us as investors is a much narrower set than what we might talk about if we were talking about politics or what we feel as a citizen or what have you.
Right.
So I'm going to hold all the latter aside and focus strictly on the former, right? So, look, I think Wall Street likes lower taxes. And so to the extent that this unified government delivers lower taxes, that's going to be good for stocks. But I think there's a lot of uncertainty, and Wall Street tends to not like uncertainty. So if we're hearing from earnings, companies saying, yeah, maybe tariffs haven't mattered quite yet, but, Ford was talking about a pretty big hit to earnings down later in the year if tariffs do hit. So we just don't know, we just don't know. And so, and frankly, it's probably contributing to our sense of higher volatility that Rick was talking about, just this, and then the last thing I would say is one thing that was assumed coming to this year that I think is coming to the administration that I think is now more up in the air is there was a thought that there was going to be a deregulatory move. There was going to be a easier FTC approval for mergers, right? And just the other day, they kind of re-upped on some Biden era policies around mergers. And so it could still wind up, I think on net, it's going to be an easier regulatory regime than the Biden administration is. But I think this too is not as clean as what I think Wall Street assumed coming into this year. So I don't know if that's a grade or not, but I definitely think there's been some things that Wall Street thought were going to be definite positives that will be, and some things that not so sure.
Okay, Andrew, what are your thoughts? If you don't want to call it a grade, we'll call it a thought.
Yeah, maybe one thought is I think he is clearly tackling all at once a lot of the things that he said that he was going to. And so I think some of the question is around, is he taking on too many things all at once, things that prior administrations had focused kind of years on, like tax policy, immigration, things like that, he's trying to focus on all of that at once. That I think that can lead to, there's a lot more volatility as we don't know what to expect, what is actually going to be able to come from all of these things. Are things going to slip through the cracks? Because so much is being focused on at one time. And I agree as far as the regulatory regime that it seemed to be a pretty strong likelihood that it'd be a tailwind going forward, with some questions now around, is the FTC going to be as maybe accommodative as people expected going in?
Okay, Rick, what are your thoughts on the first month?
I think it's been a little bit interesting. one, I think coming into the new administration, everybody's playbook, or at least most people's playbook, was, let's get long domestic, small and mid cap, and let's get short international, because, that's what the administration is going to, help. And when I was looking at yesterday's returns, I don't know where they are this morning, but when I was looking at it yesterday, it's international was up 8%, acqui ex-US, and, small and mid caps are up 2% versus the S&P, kind of +4. So, if you read the playbook originally, you may want to start thinking about throwing that playbook away, because certainly that hasn't been the way that the markets have originally sort of started to play out. The other thing that I would just say is, if I think about the Trump administration, it has been a little surprising. I feel like the administration is doing a better job this time around than they did the first time around at communicating changes that may go into effect longer before they go into effect, maybe indicating, particularly on the tariff side, some room to negotiate, giving the markets some time to react to news before it's actually, effective. I look at, tariffs on autos and semiconductors and a couple other sectors that aren't supposed to go into effect until April 1st, right? That's eons in the scope of time, certainly measured by Trump 1.0 administration. And so, in these ways, I think the administration is actually being a little bit more friendly to the markets than they may have been before. They're still, maybe suggesting some things that the markets don't necessarily like, but they're giving long lead times. They're giving people time to kind of react, maybe expressing some ability to negotiate, and not as much brinksmanship as maybe we saw, with Trump 1.0, which is, I think the market should welcome as a little bit of a change in the style of the administration's communication policy.
I want to go back to that reference you made to the international markets for a minute. I had forgotten about that. I also checked that yesterday, and it was stark. What do you guys attribute that to? That is that kind of an outlier or a surprise? It surprised me.
Yeah, I mean, it definitely seems like an outlier. I mean, from our perspective, one of the biggest questions we get, or the most frequent questions we receive from advisors and clients, is why do I have international in my portfolios at all? And especially as Rick mentioned with that playbook, you almost want to agree with them because it seems like it should be a headwind, a continued headwind for international. But I mean, valuations there are just so much not attractive, but just relative to US, they're definitely more attractive. And so some of this could just be more like a dead cat bounce, or as far as a valuation recovery, just as people are looking to rotate into things that do have maybe more potential upside from a valuation perspective. As we talked about earlier, valuations are definitely frothy here in US large cap. Yeah. And so
Tim or Rick, anything on that performance of international stocks?
I would just comment that I think as investors start to look across the sort of domestic landscape and they think about, not only frothy earnings, but, the potential, the conversation that we're going to have on, inflation and what is the future path of interest rates and what does all that mean? Maybe some fears around tariffs and what that might do to overall economic growth and earnings and everything else like that. When you look around the globe and you say, okay, I can buy some of these, developed international, companies that don't have these types of headwinds to them, that starts to become a little bit more relatively attractive. And, to Andrew's point, you don't need, when you've got valuations as depressed as they are relative to the rest of, well, at least relative to the U.S., you don't need much, to sort of blow on the tender there to heat things up. So that would be my explanation for it.
Okay.
I mean, I'll just add to what the other guys have said. I definitely think there's a dead cat bounce element here. Like what I think international was down 7-8% in the fourth quarter. So there's always a maybe not as bad as we thought effect that can happen, of course, right? There's a little bit of a rebound in the, or I guess a sell-off in the dollar, rebound in other currencies that we've seen, right? And we're hearing actually a lot of clients ask about, dollar risk. And so there could be some flows that are benefiting international there. And also the European economy is not great, but it looked like it was definitely going into recession in the second half of last year, and it avoided one. So like, again, the bar is pretty damn low. So, I do think that it speaks to, you ought to have some, because a low bar, when the bar is so high in the US, like that makes a lot of sense to us.
What are you guys hearing from clients? Stick with you, Tom. I mean, there's got to be conversations going on. I mean, Trump has been president for a month, but he was elected in November, so you've known he was coming in, and I don't want to make this so much about Trump being such an anomaly, because he has been president before. There's a precedent there for his presidency, but we're kind of looking at this as he is a stark contrast to his immediate predecessor, and he has made some big promises, and it appears that he's trying to deliver on many of them. So that's why I'm asking about client feedback.
I mean, we run a live event for our membership every month, and I take all questions. So Trump has dominated the questions we've gotten from our membership in the last, since the election. So basically, in the last 4 months, right? And and I would say that I think it's partially recently, since the inauguration, it's partially how fast he's moving. It's partially a little bit of Rick, you mentioned how there's kind of like, well, maybe we'll not enact these tariffs. No, maybe they're just a negotiation tool. But that is unsettling to average people. I think there's something to that. And I think what's going on with Musk is a little bit shrouded in mystery. People are not quite sure what's really going on there. They're not being super transparent about it. And that just feeds, with the social media and everything that is going on, that just feeds worry. So I think there's some real worry about, hey, market's super hot. Could tariffs be the thing that kind of, pricks the bubble? That's a legitimate thing. And then there's things that maybe aren't as economic, but are contributing to worries that are just driving stress amongst investors.
Andrew, what are you hearing from clients?
Yeah, I would say pretty similar in that I think the tails are fatter under a Trump, where it seems like they should be a little bit fatter under Trump administration. And so almost depending on your political leanings, we're seeing some clients now very much nervous about a larger tail risk to the downside. And you hear more kind of, should I be reducing my risk exposure in my portfolios? And then maybe on the other side, people that are maybe more pro-Trump are wanting to get more aggressive, and maybe looking for areas to take on more risk. So I think those are some of the areas. I mentioned international. That's the one that kind of in our role, it ends up kind of percolating to the top the most often, is how much international should I have, and why do I have? Usually it's why do I have as much as I do?
Rick, are you hearing anything different from your clients?
The only thing that I would say, obviously, if you're Democratic leaning, those clients tend to have a lot of concerns about what the administration is doing. And the media does not help that in any way, shape, or form, because they honestly somewhat deliberately refuse to contextualize things or put things in sort of the broader context of what the impact of any of this actually is on the economy. And the only nuance that I would just kind of add in there is that even amongst some of our stauncher, more Republican-leaning clients, the administration has come out a couple of times and said, hey, belt tightening, the American public may need to be, it may be some austerity type language coming out of the administration, which in my mind, even amongst some of our clients who I would historically associate with the most staunch Republicans, still expressing a little bit of caution, based on what the administration has sort of come out and said around, necessary belt tightening. And I think that, that's a little bit unique around this cycle. So, we will see where it goes. And then the other thing that you get is, just sort of continued commentary around, which I think really started last year, but continues into this year, maybe a little less Trump directly related, but tied into it is, with the move in interest rates kind of higher on the longer term and maybe some lower longer term expectations of returns on the equity side, really some engaging conversation with clients about what really is the trade-off associated with taking, 5 or 10% of your equity allocation and moving it down into fixed income or, some sort of alternative. Because, that math looks very different now than it did, 18 months ago. And so those types of conversations are starting to, creep up with more regularity with clients that are concerned about what the future looks like and are looking to maybe take a little bit of risk off the table.
Okay, so that's what clients are telling you. But what I'm asking you now is there a Trump trade out there? And is that unique from other, when there's a new administration, is there always a trade that you should employ or factor that in? So against that backdrop of a half-baked question, I want to ask you, what do you think clients should be paying attention to right now? So this is you telling us what they should be worried about as opposed to what they might be worried about. Rick?
Wow. I'm not a market timer, so I'll just go ahead and throw that out there. But I actually think that if I take I think that politics, the data bears this out, that if you're a longer term investor, that, that who's in the administration doesn't actually matter all that much, that markets generally go up and to the right, if you're to graph it out. In my mind, the single most interesting conversation that's going on out there that nobody's having and where we're trying to, sort of direct at least our thoughts is just around inflation and unemployment and, what that sort of evolving picture looks like and what that might mean for Fed policy going forward. I think that that's a much more critical component of where the market is going over the next, 6 to 9 to 12 months than anything that the administration is doing right now.
Okay. Tom, and I want to say, Tom, earlier, I think I accidentally referred to you as Tim. I apologize for that, and you should feel free to mispronounce my name one time.
I didn't hear it, so you could have just gone with it. I wouldn't even
know.
Well, look, I mean, in the big picture, I echo Rick's statement that you don't want politics to drive very many of your investment decisions because they're not, unless you're kind of trying to day trade tariff announcements or something, which God bless you, but that would be good luck. But it doesn't. It's not the key driver. I do think we mentioned there's sort of. I think Andrew, you mentioned there's sort of fatter tails in this administration. I do think you can put that into your thinking and say, well, gee, and one of the areas we're thinking about is interest rates. I think there's a scenario where some of the things that Trump is doing would exacerbate inflation pressures, right? Maybe not, but like I think it leans that way a little bit. So you can lean that way. And I also think emerging markets are a little bit in a tough spot because while I think developed markets could have, there's actually some tailwinds I can see that may offset tariff. I don't totally see those in emerging markets. Now the bar there is super low, speaking of low bars, but there's some special risks there. So I wouldn't say we did anything that was strictly because of Trump. But when we were doing some things, particularly in the later part of last year, we're like, well, Trump wins, this could really matter for this reason or that reason. And that was part of some of our thinking. So I think it helps, just as an aside, when you're talking to clients, if you can walk through sort of how different overweights, underweights you might have are impacted by different potential outcomes, right? I think it's, even though we want our clients to think long term in their investing, and so they should be able to see through all this. I think sometimes blithely just being like, it's just think long term doesn't feel right when the person's nervous, right? So we find it helpful to say, hey, like we did this, we did that, not just because of Trump, but I find that helpful.
Okay, I want to ask Andrew the same question, but before I do, I want to tell our audience, I see your questions. I appreciate them. I'm going to get to some of them as soon as Andrew answers this question. Go ahead, Andrew. What should clients be thinking about?
Yeah, maybe just to add on to what Rick was saying, looking at kind of big picture, more historical context. I mean, the first year of the presidential term tends to be the best year in the markets, and actually I think it was the last first year for each of the last 4 terms were up around 20%. Now, we're not expecting the markets to be up 20% necessarily this year, but I think just from a volatility perspective, I think there is kind of that historical tailwind in this first term. And I think encouraging clients to pay less attention to the headlines. Like if you were reading all the headlines about Doge, I would expect that the cuts that they've been making are in the hundreds of billions of dollars by now, but it's actually, I mean, they say 55, but then I read an article that that's likely even very overstated. And so I think staying away from the headlines and looking and thinking objectively is definitely important. And the one other thing I would add that I just read this morning from one of our macro research providers, there was a quote, I think it's a Hunting quote, that said, "If you don't know, don't shoot." And I think there just is so much uncertainty that I think you can make, I think, small tilts in your portfolios, I think, could be prudent, but making big shifts in your portfolio, just given the uncertainty, doesn't seem very prudent right now, because we just really don't know.
Okay, speaking of Doge, that leads us right into one of our questions. What, if any, effect do you feel the current reorganization of the federal government operations may have on the markets? Who wants to take that one?
I mean, I can start. I think, look, if the federal government were to lay off millions and millions of people, right, that would matter, because millions of people would be out of a job, and it would depend on how quickly they find a job, right? So far, it's what last I heard was 75,000, right? Which is too bad. Look, I don't want to diminish anybody losing their job. It's tough, but that doesn't really register in a country of 300 million people. So I suspect, and what Andrew's saying, I heard was like $8 billion. That's nothing. That Doge has actually found in fraud and waste and what have you. I mean, that's nothing in the scheme of the federal government. So my base case is that it's kind of nothing. Now, could it have political effects? Could there be a snafu with some payment going out? Like, that could totally matter. That's not going to really add up to much in terms of markets, I don't think.
I think that it's incredibly important whenever we have clients that are, watching the news, which is, by the way, something that we try and discourage. But if they're watching, the cable networks in particular, to try and get those clients to contextualize the data that they're being presented, right? Because you'll hear about layoffs at the FAA, right, or something else like that. It's like you laid off 400 people from an agency that employs like 75,000. Right? Like, I mean, it's literally nothing. But you have two sides that are both trying to scream about it, because, on the Republican side, they're screaming at, look at all the efficiency we're creating. Like, we're doing, this was my mandate coming in, and look at what a great job I'm doing with it. And then you have the Democrats that are screaming about it on the other side, being like, why are you laying people off? This is bad, et cetera, and yada, yada, yada. And in the meantime, the investing public is just sitting there, ping-ponging between the two before somebody finally, wakes up and says, like, look, like, this is, to your point, like, the number of people laid off isn't even going to register in an unemployment report, right? So, it is one of those things where trying to convince people to, contextualize the data that they get, to do a little bit of a fact check or a reference check, millions of dollars are.
So are you saying that the market impact is minimal with the reorganization?
Very.
Okay.
Yeah.
I mean, at least with anything that's been currently announced, the impact is trivial to insignificant. And so it's just one of these things that I feel like a lot of times people get caught up in. Somebody will say, like, we saved $1 billion. It's like, okay, well, like, size of the U.S. economy is somewhere approximating 15 trillion. Yeah. So $1 billion in the context of, my own personal net worth is a lot of money, but in the context of U.S. GDP, like, doesn't really move the needle that much. So it's just important for people to put some numbers in context.
To paraphrase Ben Franklin, $1 billion saved is $1 billion earned.
There you go.
All right, another question. Do you think small cap value, and I don't know why this question is being asked, but I'm assuming there's a really good reason. You think small cap value will make a comeback during the Trump administration?
I mean,
is there a reason that it would?
From you guys want to answer?
I was just gonna say, I mean, the Trump's first term in 2016, I think small value kind of in the latter part of 2016. I can't remember into 2017, but small value definitely was a place to be. I mean, from a tariffs perspective, we mentioned earlier that I think people expect kind of the playbook that small caps likely would have less of a headwind as tariffs pick up. And so I think there's lots of reasons, and the valuations are more attractive there. I mean, you have a lot of non-earners, but valuations are relatively attractive there. And so I do think it's a place, and we're marginally overweight small cap in our portfolios. not necessarily tilted towards valuing the small cap in general. So I do think there's some merit to that.
Okay.
I mean, we're a little underweight small value. So sorry, Andrew.
No.
Opinions make markets, right?
There you go. That's where you get a trade.
Yeah. I mean, I think like in the first Trump administration, coming 16 into 17 was a little bit of a reflation. People kind of forget that late 15 and into mid 16, the economy was kind of weak. Like that was when oil was busting, and there was a lot of like decline in business investment around fracking, right? So then Trump comes in, he's cutting taxes. It sort of creates this reflation trade, which is when I think small cap tends to do best, And so I just don't know that there's an opportunity for a reflation right now. We're pretty flated, if you will, right? So that's my take. Now we're not super underweight, but I think it's a little bit. I think knee jerk saying, well, it happened last time, it's going to happen this time. I think conditions are pretty different.
Okay,
we're neutral. So I'm Switzerland.
All right, let's talk about tariffs. That seems to be the biggest news out of the Trump administration. That would be directly impacting the economy and the financial markets. The Wall Street Journal online has actually a thing called the Trump Tracker. I don't know if you've seen it. It's rather entertaining. It's not a joke. They have 37 notable moves in 30 days, and they talk about all of his public statements, his proposals, the status of the proposal, and I mean, I'm not going to go down the list of them, but there's a good amount of tariffs on there. So how do you navigate as a portfolio manager, as a financial advisor? How do you navigate client portfolios through tariffs and the talk of tariffs, which it's mostly the talk at this point? If you recall, a few weeks ago, there was it kind of simmered over the weekend of tariffs on Mexico and Canada. Monday morning, the markets woke up in a really bad mood, but I think by Tuesday, cooler heads prevailed. And my thinking on that, if you recall it, not to recall my thinking, but if you recall that incident, it was the threat, and the threat was what scared people, but the reality was less scary or not scary at all. And I look at that and I say, well, the market is, as we've already discussed, is frothy. It's top heavy. It's rich, and these catalysts, these tariff talks can, even though I don't think Trump is trying to move markets, the market is just kind of sensitive to any kind of a catalyst. So that's my question. How do you navigate the tariff conversation with portfolio management, or do you just say these things are going to happen? It's going to be choppy for short periods. Andrew?
I mean, I think a little bit of the latter. I mean, like you alluded to, and we saw this before, but the bark is bigger than the bite, and kind of the jerk reaction to the headlines is probably going to move markets, and then it may settle out over time. We saw that kind of post-election with EM valuations got to maybe kind of extremes relative to U.S. large cap kind of as after Trump won, and so I think there is a little bit of kind of just almost being patient and waiting to see what actually happens.
Okay, Tom?
I mean, I feel a little between a rock and a hard place when people ask about tariffs, because I'm not gonna tell you I think it's good policy. Like I don't, but at the same time, the U.S. economy is about 3/4 services. For all intents and purposes, those don't trade across borders. Not 100% of goods trade across borders. We're one of the, I believe we're comfortably the least traded wealthy economy in the world. In other words, trade as a percentage of our GDP, both imports and exports as a percentage of our GDP, are a lot lower than almost any other wealthy country. And so, trade is between North Carolina and Maryland. It's not across borders in our country. So like you can say like it's not good policy. It'll probably raise prices a little bit. It'll probably, harm growth a little bit. All else being equal, obviously, right? At the same time, you can say, yeah, but I don't think it's what tilts us into a recession. I don't think it's what totally changes the earnings picture such that I'm bearish on the whole market. So, that's my take. It's not, I don't know, it's wildly different from what these guys are saying, but like, but I do feel like I feel compelled to sort of say, it's not that we think it's good policy. It's just that we just don't know that it adds up to, I'm going to totally change my portfolio.
Rick?
I think the single biggest thing that you have to do here is try and separate like what is politics and what is policy. Because if you go back to, that weekend that you were referring to around Canada and Mexico, I mean, it was really interesting, right? Like the administration comes out on kind of a Sunday and says, yep, we're slapping 25% tariffs on Canada and Mexico, which represents about 30% over overall U.S. imports, right? So like, this is a big move, big deal, right? It's like, it's effective on Tuesday. And then, on Monday, they get on the phone with, the respective governments of those two countries. And, by the end of the day, they've gotten concessions, which the administration then uses to say, okay, those tariffs aren't going into place. And so we're all over it. And if you look at the concessions they received, it's like Mexico agreed to send about 10,000 troops to the border, which is in addition to the 15,000 that they already sent back in 1819. So like not really that material of a move, right? And Canada, announced a $1.3 billion investment to strengthen, the security at the northern border. But let's not forget, Canada had actually announced that they were going to do that a couple of weeks before the weekend in question, right? So Canada effectively was just like, hey, remember what we said a couple of weeks ago, right? Like we're gonna do that thing, right? And the administration then, took that as a political win, to go to its base and say, look, I did what you told me to do. I've threatened these countries with tariffs.
Right, but Rick, what about so are you saying from a market's perspective, it's a wash? That's what I'm looking at. Yeah.
From a market's perspective, it's a wash, right? And that's why I was saying you got to separate the politics from the policy, right? So like, in my mind, that was politics, right? We were doing that for political purposes, and it never really was ever going to have an economic impact. Meanwhile, 10% China tariffs on China, there's a geopolitical reason why we want to, punish a rival, if you will, or damage their economy a little bit. And so that one's going to stick, right? And the Chinese have acknowledged that this is going to stick because they're going to the WTO, which is the moral equivalent of going to tell mom that somebody got, that somebody's being mean to you. So, like it's one of these things where if I look at the tariffs that are being suggested on our European trading partners, that's probably a little bit of politics, but also a little bit of negotiation that's likely to happen. And I kind of believe that between now and April, there's likely to be some changes to whatever those policies are, as our European partners come to maybe a little bit of a more favorable agreement with us on some other issues. So, as we think about tariffs and the impact on the market, it's like, look, the administration has shown itself to be a little bit more savvy this time around in terms of what the impact is on the market and how do I negotiate these things. And I think trying to delve a little bit into like, of course, we're going to put tariffs on aluminum and steel because those are politically popular, and we're trying to, protect the voters in those particular states or curry favor with those voters, right? And so those industries it makes sense to have tariffs on. Canada and Mexico, not going to happen. So, it's just one of these things that you need to be able to read under the tea leaves a little bit, or, under the surface a little bit as to like, is this real or is this just political?
So what's the risk of ignoring it altogether as an investor or financial advisor?
It's actually related, but kind of on the last question from a portfolio management perspective. While we, from an asset allocation, kind of overall asset allocation, may not be making major changes, we are looking to all the active managers that we're utilizing in our portfolios to make sure that they're understanding how this impacts kind of the individual stocks that they're owning, and how much of that kind of potential risk is priced into the stocks that they're owning. And so you'll probably see it more at the micro level than we are kind of making these overall asset allocation decisions in our portfolios.
All right, let's shift over to inflation. Okay, inflation under Joe Biden, it spiked to a 40-year high. It has been somewhat tamped down since then. I think it's still higher than the Fed's target, but is it something that investors should be worried about under a Trump administration or Trump policies? Andrew?
I mean, yeah, I do think that they should be concerned and watching it. I think maybe we're doing too good of a job of that. We are very worried about inflation, and I think maybe rightfully so. But being above the Fed's target, it had been above the Fed's target for a very long time, above that 2% range, and so is getting down to 2%, is that the right answer? I think we can probably stomach these levels of volatility. The big question is it going to move back higher? And are the tariffs and escalating tariffs going to bring us kind of back to the levels that we saw before? I mean, that's the big question. I think there's a lot that do very much believe that it will. And then some of the portfolio managers we talk to are kind of on the opposite side of it, that if you don't see the pickup in aggregate demand, that you may not actually see the follow through in inflation. And so I think it's clearly something to be mindful of, and it is going to be something that's driving the market. So you can't ignore it, clearly.
Tom, what do you see as far as inflation goes? And if you do see risk of higher inflation going forward, what are the investment strategies for that?
I mean, I think inflation actually has a lot of variables, right, that aren't all Trump, as I'm sure everyone would agree. I do think there is the risk leans higher, either we're talking about in tariffs or the immigration policies, right? They might not be that impactful, but if they're going to have an impact, it's probably pushing inflation higher, right? And then I think it's an open question about what is causing inflation, right? Like we don't, I guess we could say that the spike that happened in 2021 that you're mentioning was mostly driven by stimulus, but then it's, well, how much of it was supply chain? How much of it was, why is inflation still high when that stuff's long passed through the system? Like I don't know that those are settled questions, and so therefore you're like, well, could inflation pick back up a little bit? Could we go to 3.1, 3.2 instead of 2.7, 2.8 where we are now? Sure, that's totally possible, and I think the Fed is gonna respond to that thing. They can't. I think they'd be okay, kind of keeping rates where they are if inflation is very slowly drifting down. That's what they've said in their with their own projections, right? But if it ticks up even a little, they're not gonna be able to just kind of toss that off. They're gonna have to act, and that would be a pretty big change in how markets are thinking about a lot of things, and that may or may not have anything to do with Trump. And so you guys about investments, like I think we're overweight some factors that I think are lean toward having more pricing power. So companies with more profit margins, right? So that's number one, just a company being resilient to a period of higher inflation. If you're a price taker, it's tough, right? If you can be raising prices, that's good. I also think I'm pretty cautious on interest rates. I think that the risks, if we drew the bell curve of possibilities, I think the risks lean toward rates, longer term rates, not necessarily Fed rates, but longer term rates being higher. And so I think unless there's a recession, I don't think rates fall a lot. And so those are two things we're doing that are directly related to inflation.
Rick, what are you seeing as far as inflation and rates?
Look, we pay a lot of attention around here to the sort of core month over month print. And if you look at that, it kind of bottomed right around 0.1%. Middle of last year, and ever since then it's been climbing and moving in the wrong direction. Several months of 0.3% in the core, and then the last reading was actually 0.4% in the core, and that annualizes to like a 5% annual inflation rate, which and I when the Fed embarked on their easing path, it was the middle of last summer when we were getting that data that showed that core inflation rate just sort of spiraling downward. And, if you looked at the unemployment side, it showed unemployment kind of spiking higher. And since that time, you've had unemployment move lower by about 20 basis points. And then you've had inflation reverse course almost entirely in the core sort of month on month. And, I think there's a reason why, if you look at OIS futures, they're not calling for another rate cut until September now. And I actually think there's a 50-50 chance that the next move by the Fed is actually higher if we don't get that core month over month number fixed. And that really concerns me because I don't think the market's prepared for it. I don't think that the market is prepared for a Fed that looks at a month over month core inflation number that's running right now at about 5% clip. I don't think that the market's prepared for the Fed to say, maybe we got a little too far in front of ourselves and we need to throw a little bit of water on this party, or throw a little bit of water on this fire. I'm really terrible with the metaphors today, but I don't think the market's ready for it. But if you look at the data and you just think about the dual mandate of the Fed, it's very clear that inflation is our problem right now, not unemployment.
Okay, I'm gonna go to another question here. How do you see the fundamental value of the S&P 500 and other asset classes based on 2025 and 2026 Earnings.
Mhm.
I think Andrew's got that answer.
Probably frothy. Like we've mentioned a couple times before. I mean, valuations um, are definitely on the high side, and it's hard to imagine any kind of expansion on the kind of multiple side. And so it's going to have to, like, for the S&P to go up, it's going to have to come from earnings. And I would have been thinking I can't remember if it's for 2025, it's 12, 13-ish% earnings growth expected. I mean, the fourth quarter, we saw around 15% earnings growth, which is some of the best we've seen kind of since the post-COVID kind of rebound. I wouldn't be surprised if that ticks down a little bit over kind of as we get through the rest of the year. I don't know that we could expect kind of in that mid-teens. But I think when you look at the rest of the world, I think that you don't want to be meaningfully underweight U.S. equity, though. You want to be betting against it. But I just think I would be hard pressed to go meaningfully overweight, just given where valuations are.
Anyone else have anything on that?
I mean, I think obviously valuations are high. There's no way around that. I do think what Andrew was saying, that earnings growth is extremely high, especially for a like rebound period. Like a lot of times when earnings growth is this high, it's because it was in a deep trough before. I think a lot depends on whether earnings growth can spread out, right? I think if you have 7 companies, a dozen companies, what have you, driving all of the earnings growth, like you kind of did in 2024, a little bit of exaggeration, but not that much. I just don't think that's super sustainable. I think, whereas if it can spread out, while overall valuations probably can't expand, you could see some companies expand theirs while others kind of calm down, and it winds up being a pretty healthy market. So that's in the cards. That could definitely happen. So, but I think it kind of has to.
Rick, valuations?
I mean, look, just echoing what these guys have said, maybe say it just slightly differently. If you look at the market on either, cyclically adjusted PE ratio or just straight up PE ratio, it's super expensive. If you look at it on a PEG ratio basis, it's actually pretty reasonably valued relative to history, which in my mind just tells you that you get really lofty earnings growth expectations for 2025 and 2026. And if you believe those earnings growth expectations, then the market's actually probably reasonably valued versus where it has been in the past. I think it's up to everybody who's, a portfolio manager to be looking at those earnings growth numbers and, questioning, do I think that's real or not? Because if you think it's real, then you're probably okay. But if you start to do the back of the envelope math about exactly how much that means, particularly certain areas of the market need to expand their earnings, and what does that mean, for the just in terms of general share of the economy, then I think you could pretty quickly convince yourself that no, I don't really buy that, those forward earnings numbers.
Okay. We're down to about 10 minutes, and I want to ask you guys what you think Trump's ultimate impact on cryptocurrency will be. It's a big, wide open question, intentionally. Obviously there's a leadership shifts at the Securities and Exchange Commission, which is responsible for some of these ETFs that are investing in crypto. But we did get 2 crypto ETFs last year under a different administration and different SEC leadership, which became the most successful ETF launches, I think, of all time. But Tom, can you start us off with that? The what crypto looks like under a Trump administration, what impact his administration has?
I mean, it's kind of going to be a 180 in terms of regulatory oversight, right? Like I think we're going to go from a administration that sort of started from an assumption that every crypto project was a scam to an administration that's going to start with the assumption that every crypto project is great and grand and needs to be proven otherwise. Like it makes sense that adds something to crypto's valuation. The problem I have is, like, I have no idea how much, right? Like, what did you say, Jeff? Bitcoin's up 40% since election day. It's up more like 60% since the time Trump took a pretty decent lead, I think. And so, boy, is 60% the right number? Like, how do you know? So what I tell people is, look, I'm a French chef. I cook with cash flows, right? So don't order the spaghetti from my restaurant. It's not very good. Okay, so and crypto is the spaghetti. So I'm not. You do what you want, but it doesn't fit my sort of philosophy, and so I don't have a super strong opinion.
Okay, Tom, Rick.
Look, I think that Tom is exactly right in terms of the administration is going to be, much more favorable to these types of products. And last I checked, you can buy a mutual fund that invests in, bourbon, and one that invests in wine futures, and one that invests in art, and, a whole bunch of other things. And so why you can't buy a crypto ETF to me seems a little silly. I think that there is definitely some expansion there. I think as people start to look, though, at Bitcoin, once again, starting to try and contextualize numbers, it becomes important. I think I ran the math the other day where, when you look at Bitcoin at about $100,000 a coin, the market cap, if you will, of Bitcoin is equal to M2. The money supply in the United States. And so, is that right? Is that wrong? To me, it feels a little bit far-fetched, but who am I? I do think that the administration is going to continue ways in which investors can get access to these types of products. That is an entirely separate question as to whether or not those products are, priced appropriately and with the appropriate risk profile, et cetera, for, the vast majority of investors.
Okay. Bourbon, wine, and spaghetti so far. The analogies are getting better. And I don't know how you knew that's what I had for lunch today. But Andrew, what's your take on crypto under Trump?
Yeah, I don't know if I have a significant amount to add to what Rick and Tom have shared so far. But as far as I think it's very hard to pick the winners. I mean, I don't have any expertise, and so I think as Trump looks to legitimize and kind of bring it more to the forefront and maybe more support, I mean, I do think having some exposure to maybe the infrastructure that supports that, the kind of the picks and shovels versus picking individual crypto might make more sense for individual investors to be looking at. But yeah, we've kind of with a fiduciary responsibility and no cash flows, the things that you traditionally look at, it is hard to justify making a significant allocation in a client's portfolio. The other thing I do wonder is the more you legitimize it, does that change the kind of the return and volatility expectations going forward? That it shouldn't be. I mean, if it starts to be actually used for its purposes, it can't be up or down 5 or 10% in any given day. And does that change almost you have a washing out of all the people who kind of the crypto billionaires and all the people who've gotten rich off of it and looking for that volatility? And as you cycle into more traditional institutional investors, like that's just something that could be interesting to watch to see how that evolves.
Okay, wrapping up here with a lightning round to each of you and you knew this was coming, so don't tell me you don't have an answer. Your outlook for the markets and the economy going forward, and as Andrew requested, it can be short term or a long term outlook. Okay, so Andrew, we'll start with you, and this is again against the backdrop of Trump, please.
Yeah, I'm actually not sure which one is easier, whether it's short term or long term. Usually I would say long term, but. I think, like I shared before, the first year of the presidential cycle tends to be the strongest, and outside of a recession, usually a positive year for the markets. And so, given where all the data kind of is looking now, it doesn't seem like a recession is in the cards, at least a relatively low percentage over the next 12 months. So generally, supportive of the markets for kind of our traditional portfolios do have a slight overweight to equities as we look out over the next kind of 12 to 18 months. Longer than that, I feel like it does get a little harder.
Okay, Rick, your outlook?
Yeah, look, unemployment's relatively low. Consumer drives about 70% of spending in this country, and the administration is probably going to come through with some tax relief and some other things like that continue to be supportive of that. So. On the economy, I think we're, relatively green light from an economic growth outlook for the next, 12 months. And then I think for us, the big wild card just comes back around to inflation. If that economy continues to grow real hot, if the Fed decides it needs to put the brakes on, then the markets could have a little bit of a negative shock associated with recalibrating their sort of path of where longer term interest rates are going.
All right, Tom, bring us home.
Yeah, look, I don't think you should bet against stocks unless you think a recession's coming. So despite everything we've said about Trump and valuations and what have you, usually don't see stocks drop unless there's a recession or the threat of one. So while that's possible, there's kind of no evidence of that right now. And so I wouldn't bet that way. So I'm pretty constructive on stocks for this year. I think you got to build your defense within your stock portfolio.
All right, good stuff. Sounds like you're telling people to ride out some of the noise and the volatility, folks. And get yourself some spaghetti and wine and bourbon. And
I said, don't order spaghetti, Jeff. I said, don't order spaghetti.
Don't order
I'm always going to order the spaghetti.
You should go to a different
All right.
restaurant then.
I want to thank Tom Graff of Facet, Rick Wedell, RFG Advisory, and Andrew Goins of Brinker Capital Investments. I want to remind our audience that a replay of this webinar will be available at ETF.com tomorrow. Go to ETF.com for all your ETF information. We got an advisor center there that's specifically designed for financial advisors to help you manage your client portfolios. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com, and want to thank you for listening.